Hey guys, it's a market update. We have to remain bullish right now, certainly for Bitcoin, because the market isn't. Right, the market is uncertain. There's a lot of FUD flying around. But if you take a look at the odds in bull markets for Bitcoin and in macro inflection points as well, if we're looking at the odds are in our favor to be bullish. Even though it feels like we're in no man's land, it feels like we could definitely drop like 10,000 for the price of Bitcoin, right? Down to 46K. That could happen, but the odds are in our favor. So let's look at that and how we can actually play this. We know the Fed are going to cut interest rates. We know that's typically bullish for risk assets. And we also know that in bull markets, this type of drawdown for Bitcoin is usually an area where you can actually take some short-term positions even. But certainly if you're an investor, these are areas you have to be active. Even though it feels like we could go lower, it feels like there's a lot of uncertainty. So let's talk about it in this video. Bitcoin still distributing from the all-time high. It was a huge ETF speculative run. Some of that has to unwind. Just is what it is. We're still in this downtrend. We're still in this distribution. I don't really see anything changing too much until we maybe get some of the election debates out the way and maybe the results are a little bit clearer. Right, we know that one candidate is super pro Bitcoin and crypto. We're coming into the 50-period moving average. Bulls are trying to defend it a little bit, but look, this isn't really bullish price action. It's not there yet, so it is what it is. However, these are the times and the periods over time when you're in for years and years where you look back and think, yeah, that was a decent buying opportunity, or yeah, I'm glad I just kind of accumulated some then. That's the plan, right? Get as much BTC as possible. So we'll talk about that in this video. If you do trade and you don't have a Bybit account yet, I trade on here. Click the link below. You can get a deposit bonus up to $30,000 via that link. There's a massive amount of uncertainty in macro land right now because really people don't know what's going to happen. That is the issue. We can't trade that. Individual investors should not trade macro like this. You're just going to get yourself tied up in a knot and it's going to wreck you. So we have to have a slightly longer term time horizon and just play the odds and play the cards as we're dealt. Individual investors have to have a slightly longer term time horizon and just play the odds. And this macro stuff, we can't trade it because we're not sitting on a trading desk. So let's go through that and why actually the odds usually in this type of scenario are in our favor anyway. So look, the Fed's going to start cutting rates. The red line here, this is the Fed funds rate. Blue line is the market rate. We're clearly pricing this in right now. Probably going to come down to 2.5%, maybe 1.5%, something like that. Okay, so that's going to happen. Everyone knows it. So that's not the uncertainty. The uncertainty is we've got an election, and if the personnel change, that means that the Treasury personnel will change and maybe some Fed personnel will change and maybe the plan will change. And so because the market doesn't know this right now for certain, how can it price it in? I've seen a lot of these events. Macro uncertainty creates drops in prices, weak price action, happens every time. But then you get the certainty of something, right? So the election or people start pricing in what they actually think will happen. Even if it's bad news or some sort of event that happens where you think, that's bad news, but why is the market reacting positively? It's because they were uncertain and they are no longer uncertain, right? So they actually react quite positively once the certainty is in place. I've seen it many times. So we just have to play the odds in these scenarios. When you get weakness, you have to go in. I understand the last two recessions, 2000 and 2008, were absolutely cataclysmic. And in these scenarios, when the Fed has started cutting rates, you actually were down, 12 months after, right, on the stuff you bought. And certainly in 2000, it kept going down, right? The other recessions, and when we got these uninversions, when the Fed started cutting rates, you got some very positive price action. So the odds are in our favor here. And these events, you can't invest for them. You can't just have all of your money in cash waiting to buy the dip or buy some sort of crash, right? It's just not how an individual can invest, and it's not playing the odds. So the odds are in our favor to just invest through times of uncertainty. You can see the current cycle here playing out pretty much similar to other cycles. The macro is, of course, very important for the price of BTC if you want to price it in dollars. But the other story is that Bitcoin itself as a network is just one of the strongest networks and has one of the highest growth rates of any network, let alone large networks. That's the other side of things. And again, play the odds in your favor. Let's buy the best assets. We can also see here 30% drawdown in the bull market. You have to buy them. You have to buy them. The odds show us that in bull markets, we do get these drawdowns and they may go a bit lower, but you kind of have to be active here because if you're trying to accumulate the asset, in bull markets, you buy these drawdowns and certainly buy everything in a bear market. So the odds are in our favor just to kind of forget a lot of this uncertainty. just go in and have a slightly longer term plan about what you actually want to do here, because that's going to take away a lot of the things that could actually wreck us short term. One of the problems we have right now with Bitcoin at 56K is it's not really a support zone right now. Now, if bulls come in and defend this level, then maybe it will turn into a support zone. But we've never really been at this level before, 56, coming down from an all-time high. And so where are the bulls going to step in? Well, 56K is kind of in the middle of nowhere from a price perspective. I think what's actually much better to look at is the AVIV, or the true market mean, as you can see here. So this is a kind of updated version of realized price. Realized price takes the price of Bitcoin last time it was moved on chain. So this is a much better look into what people actually have as the price of Bitcoin, right? So you could say maybe like a market mean, as they say, true market mean. This is the realized price or market mean of BTC around 46, 47. So that could definitely be a support zone, you know, if we do continue to see kind of a drip down in markets or sentiment just kind of turn pretty bearish for BTC. Now you can see that when Bitcoin is under this ratio, they're essentially bear markets. Just you have to be so active there because that's where all the money is made, right? These bear markets. You can see in the previous cycle here, we came up above this and then we just dripped down for a very, very, very long time around this market mean, kind of pumping a little bit. Then you had the pandemic here, and then obviously that was the start of the bull market. We had the last bear market. You can see we've broken through this now. So we're still in a bull market. You know, we got up pretty high, probably too high here. And now we're just drawing down to the AVIV or the realized price, right? So 47K, that is where I would expect a lot of bulls to start coming in and start buying again, because I think we're still in a bull market. So yes, a lot of uncertainty, bulls come in. Now, if you get those crashes, financial crashes, which you can't trade for, that's when you get these events, right? Where the price just goes down 30% in a week, right? And then that's usually when the Fed steps in anyway, right? And says, oh, we're going to print money again, right? So if you get that, you can't really trade for it. You can't have your entire portfolio in cash waiting for that event. Right here, some weakness. We can play the odds, buy prices around the AVIV, right? Because you're in this asset that's growing at 40% a year. We're just going to play the odds. You can see that here. If you just buy Bitcoin, right? If you bought Bitcoin over the past 4 years, the average annual return is 53%. So you're making 53% a year buying this, buying the crash, buying the very top, everything in between, 50% a year. That's playing the odds. That's what we should all focus on. Now I want to go through some key points of Lynn Alden's latest newsletter. I will link it below. I do recommend reading the whole thing. But I think the trade of our generation is currency debasement and how to escape that. I think Bitcoin is the best way to escape that, not just because it can price in what's going to happen in fiat currency land, but also it's got the positive aspect of it, right? Bitcoin is hope because it just is neutral currency. It's got the network side of it, which is the positivity. I don't like negativity. I don't want to invest in something because I'm negative. I don't want to have something that I think I'm investing in it because I'm really negative about the world. You need to invest in something that's positive. Bitcoin has the positivity, but can also protect you from all of this that's happening. The problem is debt to GDP ratios are extremely high, and that means that some sort of financial repression must occur, right? You have to pay the debt. So either you pay it from the fiscal side and create a fiscal spiral, more debt, and more debt to pay off the previous debt, or the central bank steps in, controls interest rates and prints money. Either of those things is going to shoot asset prices higher, valued in that fiat currency. 1 Bitcoin equals 1 Bitcoin. For the past 4 decades, the US has a rising debt to GDP ratio, but falling interest rates. This kept interest expense manageable in absolute terms and especially as a percentage of GDP. You can see this down here, falling interest rates as debt to GDP goes higher. So as long as interest rates are falling, you've got no issue. So this is really why the Fed does want to cut interest rates here, because I do believe they work with the Treasury in some respect, right, to try and manage this. But essentially, you don't want to just keep, rising interest rates higher, because what that will create is obviously higher interest rates on the debt that you take out and a fiscal spiral. So how do you actually control this and try and get this debt to GDP ratio down, or at least to normalize? There's 2 choices, right? The first choice is that they keep interest rates very low, despite periods of price inflation, and debase all of the currency holders. Japan is far enough along and doing that. The second choice is that they can try to meaningfully raise interest rates when needed and contribute to a fiscal spiral of ever higher interest expense. Neither of those is very good. And both of those is going to affect the currency, right? So fiscal side, if you create debt at high interest rates to pay off previous debt, then you create a spiral, and that pushes stimulus into the economy, pushes asset prices higher. And of course, the issuer of that currency is obviously not able to pay it off, and therefore that currency weakens versus other stronger assets. On the other side, if you want to keep interest rates low, then that creates stimulus, pushing asset prices higher. There's no way around this, right? Look at the debt to GDP ratio, right? So you have to get out, and I think Bitcoin is the positive way to actually run your life as an individual investor. This is one chart that shows that as well. If you're in the currency, you're going to get wrecked. This is Apple's Treasury returns, who hold the vast majority of their Treasury in US government bonds. And the nominal return, as you can see here, that's the interest rate they're getting. The real return, which is where you take the interest rate that the bond pays and you take away the inflation rate, that is the real return. And as you can see over the last few years, huge financial repression. So the real return that you're getting is actually negative. If you hold the currency, even if you're Apple, you're going to get wrecked. And that's why MicroStrategy has outperformed every other asset this year in the S&P 500, even Nvidia. It's because they're holding an asset that's annualizing at 40 to 50% a year, and not an asset, or I should say a liability, that's actually giving you negative real returns. We can play that MicroStrategy game as well. Now, I don't recommend taking large amounts of leverage to go leverage long BTC. MicroStrategy can take debt out at basically 1%. So they can very easily pay off that debt with the cash flows of their business. But as an individual with your own individual treasury, what do we want to invest in? Bonds or currency are going to give a negative real rate over the next 10 to 20 years. You always need some cash to pay for bills, but there's no point investing in that for anything other than the cash that you need to pay your bills. So you need to be in an asset that gives a positive return. S&P, NASDAQ, some other indices, BTC, property, they can all protect you from what I think is the trade of our generation, which is currency debasement. If you aren't a Bybit user yet, check out the link below, $30,000 deposit bonus via that link. I'm James, this is MoneyZG. Cheers for watching, and I'll see you in the next one.